Today, interest rates will rise. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Internationally, we are coming out of a period of ultra-low interest rates and asset bubbles thanks to quantitative easing. And the latest data underscores that there are more risks ahead. So we look at the recent trends and consider the implications for local mortgage holders. And by the way, if you value the content we produce, please do consider joining our Patreon program where you can support our ability to continue to make great content. Here is the link. First, the Bank of England published their November 2018 inflation report last night. On one hand, there was no change as at its meeting ending on the 31st of October 2018, the Monetary Committee voted unanimously to maintain bank rate at 0.75%. The committee voted unanimously to maintain the stock of sterling non-financial investment-grade corporate bond purchases financed by the issuance of central bank reserves at £10 billion. And the committee also voted unanimously to maintain the stock of UK government bond purchases financed by the issuance of central bank reserves at £435 billion. But the commentary highlighted the trend of higher rates ahead. Back in August, the committee raised bank rate to 0.75%. That had been anticipated well ahead of the announcement, with most short-term interest rates rising earlier in 2018. And in the run-up to the November report, stronger than expected activity and inflation outturns, as well as increases in short-term interest rates internationally, have pushed up the market-implied path for bank rate. It is now expected to reach around 1.4% in 3 years' time, up from 1.1% in August. And long-term UK interest rates have also risen since August, despite falling back in the run-up to the November report. Those rates have been affected in part by the increase in long-term interest rates in other countries. So unless there is a disorderly Brexit, it seems the market is now expecting 3 rate rises of 25 basis points ahead. And as a result, the pound moved higher. And now looking at the Fed's plans, Moody's makes the point that the fast approaching midterm elections are barely a blip on the radar. Though the path that fiscal policy will take in the next year will depend a bit on the outcome of November the 6th, that policy uncertainty is not the cause for the current economic expansion to blink. So they have a go at looking at the financial market conditions through the Federal Reserve's eyes. The central bank wants to see gradually tightening conditions that turn financial markets initially less supportive for the economy and eventually neutral for growth. The Fed is trying to tighten monetary policy via high interest rates and a reduction in its balance sheet, enough to prevent imbalances in financial market conditions and the broader economy. However, too much tightening could kill the expansion, and has done so in the past. Moody's says that this will be a tough path to navigate, and they don't believe the recent tightening in financial market conditions is sufficient to alter the Fed's forecast for growth. Rather, it likely reduces the central bank's assessment of the upside risks to the outlook. So they think that if the worst of the decline in stock prices has passed, and they edge higher through the rest of the year, it would shave about 0.5% of GDP growth over the course of the next year. The volatility in equity markets is garnering most of the attention, but if the drop in oil price sticks, it should provide a small boost to GDP growth. The recent change in long-term interest rates suggests that an increase subtracts 0.05 percentage points off GDP growth, while the recent appreciation of the US dollar didn't have any noticeable impact on growth. there have been some offsets. Every $10 decline in crude oil prices boosts US growth by between 10 and 15 basis points, or 0.1 to 0.15 percentage points over the course of the subsequent year. So net, the recent developments in financial markets would shave around 0.4 percentage points off GDP growth over the next year, which is noticeable and equivalent to roughly a 25 basis point rate hike. But the economy has lots of momentum, and the recent developments in financial market conditions wouldn't prevent the economy from growing above its potential growth rate over the next year. Therefore, they say the Fed will stick to its plan and raise rates in December, with 2 additional hikes likely in the first half of 2019. Benefits of the recent tightening in financial markets are twofold. First, the Fed may be addressing some of the moral hazard that has developed in this cycle. Markets had become conditioned to assume that the Fed would respond to each decline in the stock market. This moral hazard is difficult to break out of. Sooner or later, the Fed needed to draw a line, and recent comments by central bank officials suggest that they appear to be doing some of this now. Secondly, the Fed will likely view the tightening in financial market conditions as therapeutic. Fed Chair Jerome Powell recently noted that the central bank's risk management approach to setting monetary policy suggests looking beyond inflation for signs of excesses. He noted that inflation may not signal any overheating, and that the last 2 recessions were caused by imbalances mainly tied to financial markets. Therefore, recent developments in financial markets could temper the hawkish rhetoric and increase the possibility of a pause in the second half of 2019. So, a pause is possible. The Fed knows that the fiscal stimulus will be waning in late 2019 and 2020, which will push the economy back towards its potential growth rate. Also, there is little evidence that the labour market is currently or is soon to overheat. The employment cost index for private workers was up 3.1% on a year-on-year basis, as it should be given trend productivity growth and inflation. The ECI is part of Moody's wage tracker, and it remains roughly in line with trend wage growth, suggesting that wage pressures are not significant, something that has been the norm recently. This will keep the upside for inflation limited, but demographics will be pushing against inflation as well, something of which the Fed should be aware. Periods of high core inflation have coincided with a jump in energy prices, which bleeds into core prices via higher transportation costs, but bouts of high inflation also occurred when a large share of the population was young. That won't be an issue anytime soon. So overall, Moody's says a Fed pause is likely, but not now, based on what the Fed will rather than should do. They still view the risks in their forecast for a 3.5% terminal Fed funds rate this cycle as weighted to the downside. And if the Fed does pause, it should be for an extended period rather than just a few months. The case for a pause will likely be strongest towards the end of 2019, particularly if financial market conditions are less frothy, inflation isn't running above policymakers' target, and the fiscal stimulus is fading. Therefore, odds are rates will keep moving higher for now, though the Fed funds rate may peak sooner and lower than many expect through this cycle. And so to Australia, where the recent CPI data was lower than expected, and the retail turnover out today was only 0.2% growth in the month in trend terms. All this points to local cash rates not going anywhere soon, which creates a bigger pressure gradient with the US as they lift rates, and so will likely drive the Aussie lower. International funding pressure, therefore, will get more intense. But the current BBSW rates, though a little lower than a few weeks back, are still such that more out-of-cycle interest rate rises for mortgage holders are likely. especially as the ANZ and NAB results out this week showed continued margin pressure on the banks. In fact, NAB has cut deposit rates more to avoid a mortgage rate rise for now, but that appears to be unsustainable. So it seems to me that in the short term, out-of-cycle interest rate rises for mortgage holders are firmly on the cards, but changes to the official cash rate are unlikely for some time to come. And in that respect, we are out of kilter with both the UK and the USA. And that will drive the Aussie lower. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. The link is in the comments below. And as always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.